As ICT traders, we always start our analysis from the higher time frames. So let's begin with the weekly chart. Why are we bearish on the weekly time frame? Because we have clean weekly lows acting as our draw on liquidity, and they're aligned with a partially filled weekly bullish imbalance. Based on that higher time frame narrative, our weekly bias is bearish. Now let's drop down to the daily time frame. On the daily chart, we have daily equal lows aligned with an unmitigated daily bullish volume imbalance. This gives us additional higher time frame confluence, perfectly aligning with our weekly bearish bias. With both the weekly and daily pointing to the same draw on liquidity, we have a strong bearish narrative. Now, let's analyze the 4-hour time frame. On the 4H chart, we can clearly see a strong bearish displacement that created a 4H sell-side imbalance. At the same time, we also have a 4H SMT divergence with YM. These two confluences strengthen our higher time frame bearish narrative and give us even more confidence that the market is likely to continue targeting the higher time frame draw on liquidity. Now the real question is this: why didn't the market take out the equal highs first? As ICT traders, we all know that a higher time frame draw on liquidity prevents a lower time frame draw on liquidity from being taken first. Why? Because the algorithm gives more importance to the higher time frame draw on liquidity than to the lower time frame draw on liquidity. As you can see, our higher time frame target is the daily equal lows, which are sitting right above the unmitigated daily volume imbalance. This makes it a high probability draw on liquidity and increases the likelihood of price reaching that objective first. So what confirmed our entry here? First, we had a 4H SMT divergence with YM. Then, on the 5-minute chart, we got a CISD confirmation during the micro time window between 7:50 and 8:10. Those confluences gave us the confirmation to enter the trade, targeting the higher time frame draw on liquidity, the daily equal lows, which were aligned with an unmitigated daily bullish volume imbalance. You're probably wondering why I took a long trade right after the short trade. The logic is simple. As ICT traders, we all know what the market typically does after taking out higher time frame liquidity. It will either consolidate or retrace. In this case, it didn't make sense for the market to continue ranging while leaving those clean, smooth, equal highs above untouched. On top of that, we also had an unmitigated 4H SEBI acting as a magnet. So the expectation shifted from targeting external range liquidity to targeting internal range liquidity. If you didn't understand the concepts of internal range liquidity and external range liquidity, study this chart carefully. If it's still not clear, I highly recommend searching the topic online and learning it first. Understanding these concepts is essential if you want to master ICT, because they explain how price moves from one liquidity objective to another. What's even more interesting is that one of the best ICT traders who exclusively trades inversion fair value gaps took the exact same setup I did. Here, he took the short using his inversion fair value gap strategy. Then, after the higher time frame liquidity was taken, he entered a long trade from external range liquidity to internal range liquidity, again using his inversion fair value gap strategy.